Hi, this is Roger Conrad. I'm the editor of Canadian Edge newsletter, an advisory that covers the Canadian trust sector of the market as well as other Canadian type stocks. It's been quite a volatile market for trusts across the board. One thing we've been looking at very closely in Canadian Edge is of course the earnings reports, and trusts don't have the legions of accountants on hand to get these things out in the same fast manner as, particularly on the annual basis when it comes to annual reports, as do large U.S. corporations. So it's been sort of a lag period really drawing out as far as issuing these reports. Generally, by and large, we're coming up in pretty good shape on the numbers. I think it's a very good sign that distributions will hold. And again, that's I think the key to weathering this particularly volatile time is that companies that can increase or even maintain their distributions are going to recover any kind of losses that they suffer in this kind of volatility. Some of them probably will not, but again, you can get the indication of which are going to survive and which are floundering just by the numbers, and these again are coming out pretty well as we see. One group that's particularly interesting, I think, going forward, and will be increasingly so as we get into the rest of 2008, are the energy producing trusts. And these were the real laggards over the last 12 to 18 months. One reason is natural gas prices were really coming down in a big way, or at least very, very flat, so profits from that area of their business were very stagnant. And that's really the reason why they haven't been able to enjoy some of the benefit from higher oil prices. But now we're starting to see gas prices do some rebounding, and partly that's because production has really dropped off a cliff in Canada, major source of the fuel for North America. Partly it's because of a return to more normal weather patterns in the United States, something we haven't seen for the last couple of years. And then one of the biggest things is a demand push from a real rush to gas from U.S. electric utilities. A lot of new power plants being built, a lot of older plants being started up as companies try to deal with their greenhouse gas emissions vulnerability ahead of the curve. I think there's a recognition that there is going to be legislation coming down the pike in this area, and companies are going to have to adapt. So this is the area that's the fastest. The fastest way for them to do that is to use more natural gas and less coal, and that's of course a huge benefit of the gas market. And these trusts have basically been selling their gas in the fourth quarter and the third quarter at prices that are 40 to 50% below the current spot prices for gas. So they sell a lot of production forward. That's the only way they can ensure they can pay their distributions quarter by quarter, also meet the capital needs of their business. So it means there's a lag between what they're actually able to sell gas for in the marketplace and what the actual price of it is in the marketplace. So that's a tremendous upside for them going forward. They're going to be able to sell it at higher and higher prices as old contracts are replaced by new ones going forward, and that's going to be a tremendous lift to their earnings in the first quarter and probably on through the rest of the year. On the oil side of the equation, they've been selling their oil for $25, $30 below the spot price in oil as well. So the same kind of thing holds. As contracts come off, they'll be able to sell it at higher prices. And again, this is a nice underpinning to earnings, particularly in a very volatile period for the market. And even if energy prices should come down, it means that they have a lot of room before it starts to affect their bottom line. And in fact, even if energy prices should come down significantly, we can still look forward to higher earnings as they are actually able to lock in higher and higher prices for their output than they're getting right now. So it's something that a lot of people are paying attention to. It's very bullish for their distributions. It's very bullish for the share prices, I think, going the rest of the year, even with the U.S. economy looking fairly weak. So thanks for tuning in today, and we'll look forward to talking to you next week.